I'd like to welcome everyone to today's session on behalf of the National Network of Credit and Financial Professionals, as well as the Federation of Credit. We have a unique opportunity today. We have partnered with a prestigious association called the Commercial Collection Agencies of America. And if you don't know, these are the folks that certify the collection agencies that we all hold in esteem and are partners to our respective organizations. With us today, we have the Executive Director of the Commercial Collection Agencies of America, Annette Waggoner. And before I ask Annette to take over the floor, I'd like to share with you just a little bit of housekeeping rules if you are new to using the Zoom platform. If you take a minute to either mouse over or scroll over the bottom of your screen, you'll see a navigation bar that pops up. And in that navigation bar, you have a Q&A button. We'll be taking questions throughout the webinar and throughout the presentation using the Q&A. And when you type in your question, I will read your question to the panelists and we'll make sure we get to answer everyone's questions. In addition to that, we will be sharing the presentation today in a PDF format for everyone that registered for today's session. And in addition to that, the folks that are subject matter experts for today will also be sharing some reference material that will be emailed to everyone after today's session. Lastly, before I forget, because Alyssa will yell at me if I don't say this, at the end of the presentation, you're going to get a quick survey asking for your feedback on how we did today. It takes less than a minute to complete, and it's really fantastic feedback for us in order to continue providing these types of webinars and education sessions. So with that, I'm going to turn it over to Annette, again, Executive Director of Commercial Collection Agencies of America. And Annette, please introduce us to your fabulous panel.
Thank you, Yassine. We are elated to be with you, and we thank you for the invitation. We're looking forward to today's session. So today with me, I have Meg Scotty. Meg is the CEO of Brennan and Clark. She's been in the receivables area since 1987. She's gone from consulting, working for, and eventually purchasing Brennan and Clark. She has created a fun, focused, and purposeful organization. In 2014, Meg championed creating Commercial Collection Agencies of America, where she served as president. She now serves as past president and is a member of the Independent Standards Board. Joining Meg is Tom Claybaugh. Tom is the president and CEO of Mountain States Commercial Credit Management. Tom also began his commercial collections career in the 80s, and he joined Mountain States Commercial Credit Management in 1998, and now he is president and CEO. Tom is a member of the CRF Foundation, a Credit Research Foundation, and a founding member of Commercial Collection Agencies of America. Welcome, Tom. Welcome, Meg. Glad you're with me today.
Annette. Thank you for having us.
Absolutely. So let's get started. We'll start with a little housekeeping. Of course, we have to tell you that the information is not intended for legal advice, cannot be used as such. And so if you could refer to this information in the purpose in which it is given and consult your legal counsel. All right. I'm just going to talk about commercial collection agencies for a second. I have the honor of serving as executive director. We started the organization in 2014, and the agencies that are part of the organization are the most tenured commercial collection practitioners in the industry. They earn the highest level of certification in the United States. They do that by adhering to rigorous certification requirements, which are promulgated and maintained by an independent standards board. We call it a triadic organization because we also have affiliate members, law lists, and creditors' rights attorneys. we are proud since 2016 to be a platinum partner of the Credit Research Foundation. Okay, so this is what we're going to go through today for you folks. We welcome your questions throughout the presentation. This is a casual discussion, hopefully that will impart a lot of really great information. So we're going to cover what's happening today, what the landscape is currently, then communication pivots, and then finally we'll end up with we're looking towards tomorrow and what is happening in the future. Sounds kind of broad, but we have a pointed conversation for you. So let's start about what is happening in the United States and globally that will affect your industries, which include but are not limited to the building materials supply industry, the apparel and footwear, and the pharmaceutical. Meg, I'm going to throw it to you.
Well, thank you, Annette, and Yassine, thank you very much for the invitation to speak to your group. I look forward to today's discussion. It's nice talking to somebody else other than Tom and Annette all the time. We collaborate a lot, so it'll be interesting to see how this performs today. As we're typically just kibitzing with each other, so we'll keep it professional and hopefully some useful information. You know, there's a lot happening, and we all know there's a lot happening, and I think that's the reason that we've all joined and signed on to listen to what's going on. You know, in a nutshell, extended payments, late payments, uncertainty, higher DSO, changing credit behaviors. You know, that about sums it up. And not only in the United States, but globally. In late 2020, one of the last studies I saw was that 80% of companies have lengthened payment plans throughout, you know, from March on. And since that extension, even 4.6% of those said that they've extended payments even beyond that. So I believe that we're all feeling, you know, the cash flow issue and the delays and, you know, moving to, you know, different areas of concern and really, you know, buttoning up the holes. That I know in the building material supplies, you know, the commercial construction index says that they expect that the shortage of supplies to, you know, 71% of them surveyed said that they were going to extend way into 2021, most of that in the lumber. And shortages are going to impact, you know, costs and lead times, and, you know, more prep is needed, and it's going to affect all areas, and it all trickles down. You know, the Moody's status for, you know, apparel said the same thing. It was disastrous in 2020. You know, profits plummeted, and by the second half of the year, they expect some of that to improve. That profitability will raise some in the second half of the year. As I said to Tom and Annette, I'm not familiar with the pharmaceutical and medical devices. Those of you who can banter or chime in with the chat, I do know that more regulations are coming into effect in 2021. The medical arena, you know, the regulations, I don't want to say lax, but they're coming up into, and there's more and more of it that's going to roll out in 2021. So please voice your experience to us. We're here, you know, it'll be more dynamic if you all chime in. And then, you know, yeah, there's a lot of unemployment, political divisiveness, civil unrest. Even with that said, in 2020, that small business startup was at an all-time high. Now that was all on the online front, but again, there's still, amongst the uncertainty, there is still a lot of good things happening. You know, so this isn't doom and gloom. It's, here are all the factors. What can we do about it? And, you know, Tom is, in his expertise, is going to go into, you know, the credit reporting world and what, you know, how the scoring has been affected, has changed, and we'll move on. So next slide, Annette.
I think that's me. That gives a nice segue into me being thankful for the invite to be here, Yassine.
So Tom, before you get started, I'm going to interrupt you. We have a comment from the attendees, and I think this was related to what Meg was talking about within the pharma industry. And someone shared, in the pharma industry, we're concerned with hospitals and clinics struggling. So I think that's where the concern is coming from. So thank you for sharing that.
Yes, thank you.
Thank you. It's probably especially in the rural areas, at least here locally with us, hospitals. So again, thank you, Yassine, for the invite. We've all had a lot of fun putting this together over the last 3 weeks or so, and I really appreciate the opportunity to participate. So I'm going to take this slide here, and we're going to kind of garner a little pulse on the impact of small businesses. Obviously, consumer confidence in the United States is declining. In fact, it's 21% down year over year compared to December. A delayed economic recovery, while most pundits and economists still feel there's going to be a V curve or a V rebound, it's going to be put off until 2022 when we recognize a full recovery, hopefully. Government stimulus and relief packages, they continue with the new PPP program, as well as some other things that we'll talk about. The new Congress is going to be giving us some additional stimulus. Delinquencies, they're rising. Forbearance is ending. Loan modifications are ending, and moratoriums on collections are ending. Foreclosures, while it's been abated for a while, they're on the horizon. Bankruptcy filings are down for now due to the stimulus. Unemployment is at 6.7%, which is kind of leveling off, hopefully. Then that's really, we can segue on into the effects of the Paycheck Protection Program if you want, Annette.
Thanks, Tom. So many of you are familiar with the Paycheck Protection Program. Perhaps some of you were instrumental in obtaining that funding for your company. At least you know about it. Just a brief overview. The first round of it, Congress allowed $349 billion, and that was entirely allocated by April of 2020, the beginning of second quarter. So recently, the SBA reopened the first draw for companies that didn't take advantage of it back in April. So for those companies that did not take advantage of it, they have a chance to apply for it. They have until March 31st to take advantage of that. Now, for the companies that did get the first draw, they have another bite at the apple. So it opened January 11th of this year. $284 billion in funding was allocated for small businesses and there are a couple of qualifications. Number one, your business has to have 300 employees or less. You also have to demonstrate a 25% decline in your revenue, and that's for certain time periods. Another thing that the stimulus package did with regard to PPP was it simplified the forgiveness if you took it on the first draw. So if you got your money back or your customers got their money back in April, the way that the bill was written and eventually adopted was that now the borrower, who would be your customer or your company, you only have to submit a one-page certification. And what are you certifying? You're certifying the loan amount, the amount of employees that you retained, and also the estimated total amount of the loan that you spent on payroll costs. So what was interesting, because I'm a data nerd, is that the SBA released loan data for over 600,000 borrowers. So and we're going to get into how the PPP will affect your customers. But if you're interested in knowing if your customers received a PPP loan in excess of $150,000, you can click on that link or go to that link, and you can find out exactly how much they received. So that's PPP and how it affects your customers and how your collection efforts can, and we'll get into this a little bit later, but how your collection efforts can be altered with the PPP. Tom?
And I think it's important to know your customer, as Annette mentioned there, and hopefully we'll better understand the position of not only your customer, but also some of you, as Annette said, might have participated in the stimulus. Because the SBA made this information available to us, we have some totals here that, 5.2 million loans were given through the PPP program on the first draft of it through October. Of that, 4.5 million companies, those loans were under $150,000. And 2/3 of that number were under $25,000. But a total of 5 million companies. If, according to the US Census Bureau, there's only 25 million businesses in the United States, that's roughly 20% of all businesses participated in this program, which to me it's pretty astronomical. It's going to affect all of us. They're all participating.
I think Yassine has a comment, right, Yassine?
You know what? I just popped in and I felt badly that I don't want to keep interrupting Tom. So I think
no, please, I'm okay.
No, we'll be here till tonight if you don't interrupt. So.
I think this question is for all panelists, and the question is, can I ask my customer or debtor if they have received PPP funds?
I believe you can. You can ask them. What you can't do is you can't ask them for anything other than what the SBA has determined those funds be used for.
And I think Meg and we're going to discuss this a little bit later on in our presentation as far as how you address that with your customer and in a collection call, because it's the PPP funds are put out there for a purpose, and it might not be the purpose of you getting paid. So you just have to be somewhat careful there, and we'll address that later on in the presentation as well.
It's a fun question.
Yeah, it's a fun question.
Tom, I'll throw it back to you to give us some more information regarding PPP.
Okay, with that information, over 5 million companies have obtained these. Let's look at the payment performance of PPP recipients versus the non-PPP trades that are out there. Side note here, you're going to notice Experians on some of these screens. It is by no means a commercial for them. You all have your own data aggregators and repositories that might produce a lot of this information for you as well. Just Experian is what I'm most familiar with, and that's why I'm sharing this with you. The results would be the same using somebody else, I feel. But I'd like to bring you over to the right side and explain a couple of these scores that I'm going to relate to. And right in the middle, it says average IPv2. That is a score of 0 to 100, 100 being best, of the probability of this particular subject going 90 days delinquent with you in the next 12 months. And we call this when you will get paid. The score underneath that is a financial stability risk score, and this is designed to tell you if you will be paid. Still 0 to 100, 100 being best, and the probability of that company having the ability or maybe even being around to pay you in 12 months. And what you note here is that the non-PPP companies are scoring a bit higher, 4 and 5 points in this scenario. If you move over to the left, what we have circled there on the PPP participant increased their average bad rate by 3.2% from July through October versus the non-PPP companies at only 0.6%. What this shares with me, I feel, and a bad rate would be 90 days delinquent. Looking at these numbers, I feel the right companies received the PPP loans. They were struggling prior, during, and after. One thing to note here is during the, with reporting your information to the repositories, you had limitations. Experian, D&B, some of the others, especially on the consumer side as well as on the commercial side. If you were giving them forbearance, then you reported the claim, or I'm sorry, your account as being current or within terms. Okay, that's just a little side note there. Any questions on that slide?
I think Yassine will pop up, and that's how we know the
Okay.
next question.
All right, thank you. So another challenge for your customers and for small businesses, they are running lean on cash, obviously. It's not surprising that foot traffic went way down last March. Some industries were affected worse than others. We started to climb back into the game back at the end of the summer, beginning of fall, until November or so, when more COVID restrictions were apparent that we had to start slowing down on foot traffic again. During that same time, commercial inventories, according to the U.S. Census Bureau, year over year, business inventories went down 4.7%. Meg had mentioned earlier about the construction supplies. That's not surprising to anybody. And commercial confidence, just like consumer confidence, waned to this lowest point in April when we were all scared. I was scared. I know a lot of my fellow compatriots were scared as well. What's happening? We rose back up until I think that last column there is November, which just prior to the holiday season, where it starts to dip a little bit because of COVID restrictions made themselves relevant again. So now, how does this affect us understanding what your customer is being challenged with and how they're faring in the new year, how small businesses are? They're seeking credit at a much slower pace. Originations are down due to the stimulus. Delinquencies are rising slowly through the close of last year. Bankruptcy rate, Chapter 7, Chapter 13 are at a very low level. In fact, the lowest level since 1986. I think there was a total of 529,000 bankruptcies last year, and that's compared to recent highs in the earlier years of 800,000. And we have some new bankruptcy laws that are coming up. Are going to streamline it. Chapter 5, I don't know a whole lot about that yet, but it's going to streamline the process for some. Businesses are closing at a high rate, ending in 2020. Some of the challenges on the horizon for your customer. Their forbearance and their modifications, they're ending. Moratoriums on collections are ending. Local COVID response continues to impact the foot traffic. Businesses are reevaluating their commercial real estate needs as we all get more and more comfortable with working at home. Stimulus in January, the new COVID relief package. As Annette was touching on earlier, there's an additional $284 billion that is going to be made available for the PPP extension through the end of March, and streamlined forgiveness under $150,000. In addition to that, you have $64 billion that has been set aside for grants for economic injury and disaster loans. What really, can we go back to that slide just a second, Annette? Thank you. What really, right in the middle, there's a chart there that talks about payment behavior of recipients. And the big takeaway that I get from this is that regardless of the delinquency rating before an accommodation, trades with no payment during the accommodation are much more likely to be delinquent after the accommodation. So this is something I think to pay attention to and hang on to as you evaluate and review your own portfolio. Some of the folks that were struggling that you maybe made accommodations for, did they try to keep paying during the shutdown, if you will? Do they try to make some attempts? So now you can roll over to the next slide.
You know, Tom, that's it's a great piece of information in the blue box, right, that you read. Regardless of delinquency rate before accommodation, trades with no payment during accommodations are much more likely to be delinquent after accommodation. I mean, I really think that that says a lot of the complexion of the debtors. And as we were talking about yesterday, you know, we've seen a lot in the years that you and Meg have been active in the industry. And I really think that we glommed onto that, that piece of information. I think it's important for the folks on the call to really look at that, because it gives them insight into their customers.
Most definitely.
Right, and it helps bucket your customers, which Tom is going to talk about now, into where do I need to be paying attention. These are the behavioral changes of customers that we're seeing, and we have to make mental note of that and perhaps change our policies to accommodate it. But sorry,
For
Tom.
sure.
Yeah.
No, please.
We're just
Please,
trying to steal your thunder, Tom.
No, I need it stolen. All right, as Meg was saying, where do we spend our time? We have some increased challenges. We're always trying to improve our DSO, increase our cash position. That's a given. But times have changed just a little bit. How do you identify slow pay versus potential bad debt, which is what we're always trying to do and to spend your time. The challenges that they're talking about there is that you have an increase in delinquent accounts, moratorium on collection is ending, and now what are your resources looking like, your constraints? Do you have the same resources as you did 12 months ago? Internally, I know a lot of my clients have really cut back, and they can't bring back those people as their moratoriums are ending and the forbearance is ending, and they need help addressing these. So there's nothing magical about what I'm going to show you here, and we can simplify it. Whether you have 30,000 active accounts or only 300 active accounts, hopefully you're segregating your buckets of your portfolio. And if we apply a basic pre-treatment strategy, we can help increase the recovery of the early to mid-stage delinquencies, and again, show us where to spend your efforts so that you can focus on your resources on your slow pay accounts. The highest scoring accounts, we're going to give them a chance to self-cure. And then the lowest scored accounts, we're going to triage and identify where they need to go. So that being said, if you can imagine, up in the top right-hand box is good pay. The left top box is slow pay. The bottom left box is no pay. And the right box on the bottom would be someone that might have some issues, delinquencies, service problems, missing invoices, things as that. So to be a little more sophisticated letter, with a 30,000 accounts, let's say, what Experian has here is a couple of credit scores. One of them, again, if, the other when you're going to get paid. The highest scoring, all the way up in the right, would be those good paying accounts that are going to self-cure. Let them sit, give them an opportunity to pay. Where you should pay your attention, however, though, is on the left side. This is the best group to spend your time and energies on. They're slow pay, but they might need a little bit of prodding from you. And now we're in competition for the same dollar with your competitor. So you might want to make that phone call just a little bit earlier. And we're going to talk about phone calls and the lengths of those later on in our presentation as well. Down on the bottom left, those are the ones that if you spend too much time there, the return on that time isn't going to present itself in the way of as much cash as you can get. So that might be ideal for some third-party intervention or help, such as your collection agency that maybe you're using now, or some other outsourcing help. And then to the right, these might be service issues that you might have to address with some disputes and get more involved. The benefits of doing something like this and putting up a program, again, you can have a sophisticated scoring program or just internally have your own high balance down and then your own history of your accounts. Benefits, it's going to reduce your cost. You're ranking the order, the treatments in the terms of your collection cost. You're optimizing collection efforts, applying appropriate treatment strategy to which bucket that it belongs in. And you're mitigating your accelerated balances. So expedite outside collection agency efforts and fill disconnects for the low scoring accounts.
That's really great information, Tom. That's really wonderful. And I think that's a really useful tool also.
Right.
Again, many of you are probably even utilizing this and you might not even know it, but it's just kind of organizes your portfolio.
So we've covered what's happening today and given you some resources with what's happening today. Now we're going to go to the second part of our program, which is our communication. What can you say? What can't you say? And really, how do you say it to be most effective?
Right, we have, thanks Annette, that when we talk about communication pivots, for our conversation today, it's our verbal communications and what we call the traditional, picking up the phone and doing that. But I have to tell you that another area that I'm, pretty certain that you've all thought about is our communication style has to change. And we've conquered that through this, since March, since the shutdown started, where you can't get anybody in, the receivables department, the payables department. They're all at home. They're not answering the phone. You make a call, you got to wait for one. So it's improving your technological aspect. And, some of the reports that we look at as third party is that you're going to reduce your DSO. You're going to curb your overhead. If you have the emails, you've updated all your communication styles, you've automated your invoicing, you've automated your banking. So for our purposes, it's all, the mindset, the attitude, and what we, verbally can say. So we really don't know, what your specific issues are. We can only guess. I mean, Tom mentioned some, Annette alluded to some. Is that we have customers that don't know if they're going to be around tomorrow, or you don't know if your customers, they're in business now, they're gone tomorrow. We've got, municipalities and government run companies, their budgets are tightened. So it's, your issues are, are they going to be around, and are they going to be disputing it? Were there supply issues? So all of this is morphed, and that would all be consideration, I believe, of how you bucket your accounts. Again, that'll work into the mix that Tom was talking about. So there's the credit stuff, and there's also, you're on the front lines with your customers, and you know how they operate. You understand their behaviors, but take a look at some of those. What we can and can't say, I would always fall back onto use your common sense. There was one question, can we use the PPP? Can we ask them if they received the PPP? You could, but what's your intended outcome? What do you want to know with that? So that's when we say, ask the qualifying questions. And again, a lot of you are probably doing this without really thinking about it. I think the number one philosophy that's helped us and with all of our education within the commercial collection agencies of America is we focus on back to basics. Negotiations 101. Listening 80% of the time. You ask questions that aren't closed-ended. You want it, the whys and the hows and the, how. Tell me about that. Actually, people within my organization, they're so sick of me saying, well, why don't you tell me about that? Because they don't want to talk to me. But it's just like, well, how about this? What about this? The number one question I think is best when you are dealing with somebody who says, I have no money, is, how much are you short? How soon do you anticipate being able to satisfy your obligation? What do your receivables look like? What jobs do you have on the horizon? So it's just, you want to keep them talking. And what we've also found is that what used to be a 3-minute conversation is now a 15-minute conversation. And that is strategic. I think every single one of us in the association or from a third party we understand that we've got to listen. We have got to have some empathy, we don't want to say sympathy, but there's a whole lot more going on. Their Wi-Fi wasn't working. They couldn't do this. They have no money. They're concerned about their family. There's so much going on here that I believe everyone would be foolish if they didn't really understand, and be thinking about that, because you're going to get better results. And the other item is, knowledge is power. That's back to basics. You have to understand your customer before the call. And I think talking to the one participant that talked about, can we say about the PPP? It might bode you well to understand, or to be quick, look them up to see if they received the PPP, because then their employees were paid and they have some reference, and they're able to utilize some of the funds from the low sales into paying their balances. However, it's good for you to know that before you pick up the phone. Would you agree, Tom?
Most definitely. It's just knowledge is power, and hopefully you're preparing for any call prior. You might already have a relationship with Joe that you talk to in accounts payable all the time, but to maybe making sure, did he get the invoices? Are you sending out statements? Having that knowledge of did he participate in PPP, I think is powerful. The same thing, at the same time as you're doing prepping for the call, it might be a good time to look at your credit applications. And I might be a little bit too premature here.
That's okay.
But we'll probably segue into this as far as protecting yourself down the road. But having those calls with them, the empathy portion of it, you can maybe share your own experiences. And then preparing for that call, and we'll get into reviewing your file, what it's missing, some updates on personal guarantees, etc., that you can bring into your conversation.
Tom, when you mentioned that Pete may no longer be with the company or whatnot, I know that I've had a lot of my customers ask me to run items through the scrub process to find the new controllers, the new CFOs, the new people in charge, so that they can change their databases to reflect the new people to save time going forward too. So don't always assume that you're going to be dealing with the same person now with the layoffs and the change in the guard and so.
Hey, you guys.
And I popped back in, so that means we have another question from the floor. I magically just pop in and out. So this question was submitted by Anne, and Anne says, Tom, you mentioned Chapter 5. Can you share just a little bit more info on that?
Yes, the way I understand it, I guess it'd be similar to a reorganization. I think it's $7.5 million, I believe, anything under that, but it's more self-curing, and there's some timelines that are involved. I would check. I am not a bankruptcy attorney, nor am I an attorney, but there is some additional information I've got on the other side of my office over there that I could read into. But basically, I think the whole premise of it is to streamline Chapter 11s. I'm not 100% sure if it's a subsection of Chapter 11 or not, but it might be a nice topic maybe to ask some of our bankruptcy attorneys that belong with the association for some updates.
And we can certainly include that information. We can get that resource to the folks and include it in the follow-up.
Right, but yes, and basically, if you can think about it, it's going to expedite. I think there's 60-day deadlines and then another 90-day deadline, so that you're in and out of bankruptcy like that. As well, I don't think the creditors have a committee, but a trustee is more involved. Again, that's just kind of the 30,000 foot level, so it's going to be a little bit easier.
Thank you for that. And just for everyone's knowledge, I know that the Credit Research Foundation is going to be sharing information from their wealth of expert bankruptcy attorneys. And we hope to be hosting another educational webinar specifically on that topic very soon. So, with all the information that you guys have, and hopefully with the trove of info that CRF has, we'll be sharing as much of that in the next couple of weeks as we can. So thank you for that question.
Yeah, thank you.
Thanks, Yassine. I'll just comment quickly on this so we can move into our next slide. When we talk about settlements and we talk about, first of all, we were talking about finding out whether they were funded or any other source of funding. Before the stimulus package, that was something that we always recommended that you found out from your customers. Where are they getting their money? Where are they getting their funding? When you talk about settlements, always remember, the time value of money, especially during this time. The courts were shut down for a long period of time, and now they're running again across the country, but not to the optimum that they were running before the pandemic. So look at your settlement parameters and determine now, during pandemic and post-pandemic, if they should be the same that they were pre-pandemic. And then remember that, that $60,000 now is maybe a better settlement than holding out for 2 years to get that $75,000, and certainly through litigation. Wouldn't you guys agree?
Most definitely.
Mm-hmm.
I'm having more and more of my clients where they would not accept a settlement prior to COVID, and now they'll basically take anything or else bring down to 50%. And again, it's money now versus potential money later.
Right.
Right. And I think this brings back to, not full circle, but almost back to always looking at your company's directives. And, you might have set new policies and met as a team back in April and May and said, okay, here's our credit policy. Here's what we're going to take. Then, don't think that that's the end of it. I would recommend continually going back and looking at it, because quite frankly, where we're at right today is that my policy might work. We're going to raise or lower the extension of credit. We're going to allow X amount of time, right out the gate without talking to a superior. You can take X amount in payments. And as Tom was saying, get the settlements. Another layer to that would be that while the courts are still open, they are so far behind. And so I have, again, Tom was mentioning it, people would never take settlements. And now it's like, okay, settle, because I don't know if they're going to be back. I don't know if they're going to be shut down. I don't know if they're going to go out of business. A couple of months ago, we were thinking that the bankruptcies were going to skyrocket, and they haven't because of the stimulus came in. But, there's going to be companies that, are over 500 million that are going to be filing bankruptcy, but most of them under, they won't have the money. And those are the ones that'll be utilizing the Chapter 5. So maybe get those funds before they decide to file bankruptcy. So again, it's all whatever your company directives are. It just, it's the change in behavior, and be aware of it, and utilizing and getting, the most amount of money with the least amount of effort and the least amount of time. I mean, again, the old adage. So that's what I would recommend. And then,
good.
Go ahead, Tom.
No, are we done with this slide? I mean, we could take off on this for a little bit longer, but
yeah, I just wanted to talk about the executive orders a little bit. And I know, Meg, you have some information about, at the beginning of the pandemic, your third-party agencies were subject to federal regulations, state regulations. To know that, to ask them, to make sure that they are following those executive orders. Meg has a couple of specific examples with like Colorado and also different states, and then also work from home.
Right. That was a task that we topped on top of our compliance director. It was a fluid situation, and every day executive orders were coming out, and creditors, didn't have to pay much attention to it, but as Annette said, the third party, we were, it was do or die. There were several states that put a complete moratorium on collections, and nobody could collect. And then the departments of insurance put another layer of that on. And what was most interesting was that that the natural disasters, more and more states were, I was teasing a couple of days ago. I said it was like candy that, Louisiana said, oh, too many storms, nobody can collect, stop collecting. North Carolina was like, oh, so it was, we not only had the pandemic moratoriums, but there were more and more weather-related natural disaster moratoriums. And we're so happy to say that today that there's, two main states that still have the moratoriums, and they're in the consumer environment. So if it's a B2B and you're not pursuing a personal guarantee, nothing that I would worry about. Colorado, you cannot make any outbound calls until February 1st. There's Washington, D.C. that says 60 days after the national emergency is over, they've extended it to July. And the collection agencies just had a win last week. The state of Minnesota said that we can all work from home. That was another executive order that, we all have to be licensed with all our branch offices. So when we saw that all of our remote employees, those were remote branch offices, that there was a chance that we had to license all of our employees at their homes. So we're happy to say that's done. And it was a win. So
she's back.
I'm back. So we have a question from the floor, and this one's coming in from Scott. And Scott's going back to our Chapter 5 discussion. And he says, what about preference payments? Are these also subject to reclamation and bankruptcy actions?
At this point, I would imagine, again, it's new. I'm sure that there'll be some sort of preference, just as there is in others. Hopefully we'll get some additional information on that through the attorneys that represent Yassine's group as well as CRF. Sorry, I don't have the straight answer there right now. It's across the room, though. I could go read it.
It's going to be a big topic this year.
Oh yeah, it has to be. It has to be. If you think about it, we are looking at something that I think I've used the word unprecedented probably a few thousand times in the last couple of months. So something had to be done on that front. So we're finishing up with federal and state regulations, and Meg touched on commercial versus consumer, right? So some of those executive orders were only for when you dealt with consumers. So we thought we'd spend a little time about determining whether your account is consumer in nature or if it's commercial in nature.
And on that same point, let's take the building industry, because I believe we do have some builders here, suppliers. Say you have a contractor that has an account with you, and he comes and he picks up a load of lumber, takes it to his house, and builds himself a really nice deck for this spring and summer. By definition, according to the Fair Credit Reporting Act, or the FCRA, that's defined as personal consumption. So do you treat it as a consumer account, or you treat it as commercial, since he bought off his commercial account with you? As opposed to a personal guarantee, where he's just personally guaranteeing whatever that debt is on the business side. Sole proprietors, they're going to be personally liable, but there's a lot of, again, according to the FCRA, a sole proprietor is not personally liable until all assets of the sole proprietorship have been exhausted. So I advise my clients to, although they are a sole proprietor, go ahead and still get that personal guarantee, so you have that continuing guarantee that you can enforce. once the business becomes delinquent. I don't know if that helps at all or not, but knowing your customer is huge. I look for the legal advice that you need to if you're going to move something forward. In our world here, we work with commercial debt, but we treat anything as if it could have been consumer. So we're always careful, abiding by any type of regulations that we need to.
And that's a safe way of doing it, Tom. I think a lot of the agencies in Commercial Collection Agencies of America are very cautious when it comes to that. I would recommend that the folks on the call go back to their source documents, their credit applications, their personal guarantees, and use this as an opportunity to reacquaint themselves and even, ask the customer to update the information. We often get questions, and we conducted a survey not too long ago. Are there compliance differences between first party and third party? So when we went out to our membership, first we asked them, and we do have a pretty good idea of how many folks do first party as well as third party. And we asked them, are you aware of any regulations for the first party that aren't on the third party? And they said no. So I think it's most important here to know that when you are using a qualified agency, and I'm sitting in the seat that I sit in, not to do a commercial, but to tell you that you have to make sure your agencies are properly vetted. And the way that you do that is to make sure that they are accredited and they are certified. When you do that, you are protecting your brand. Make sure that the agency that you are using is adhering to all of the regulations that they need to. And we make sure that our agencies who are certified are doing that. So we're kind of doing that work for you. Hi, Yassine.
Hey there. So I have a question for all of you as a panel. And the question comes to us from Janet. And Janet says, or asks, what are your personal thoughts on commercial collection agencies continuing with remote as the new norm? Highly likely, not likely, etc.
I'll tell you, I'll give you my opinion. I think that it is going to be up to the state regulators. When Meg touched on the point of, we getting a big win, many states say that you have to license your branch offices. I heard from many of our members that at the beginning of the pandemic, if we have to do that, we're going to go out of business. Not because they weren't able to do it, just it was too expensive. Then we meet with the regulators and they say, oh, on the other side, that's a source of revenue for their state, and talk to the legislature. We have to talk to the legislature, and that has to change in the state legislature. So to answer your question, I think our work from home, yeah, we'd love everybody to work from home, right? If the proper, and we're, again, you're using a certified agency, so you're making sure that they're protecting your data and their data. So that's a given. But I think the decision whether we continue and for how long to work from home is really up to the state regulators. How about you, Meg? How about you, Tom?
I agree. I know personally, at first, when I moved everybody home, I was a little leery, but I found we didn't skip a beat. We know how to do it now. And some of my folks were more productive than when they were in-house. And I'm sure that happened to any type of small business or large business out there. My most recent new hire is out of state. A year ago, I might not have done that because now I know how to set it all up. So I don't know about you, Meg, unless the regulatory agencies tell us, no, we can't, or the state licensing.
Yeah.
We're going to do a hybrid of both. Yeah,
that's an excellent question, Janet. And one of those stir the pot questions, as I call them, that it brings up so many emotions that, my first comment or my first thought process was my control issues really had a hard time with everybody working from home, because it was that fear base that I didn't think that we were going to get the same production, but now it is, I'm pleasantly surprised. We've embraced, the Teams, Microsoft Teams and all the questions, so we don't feel so far apart. And it's a tough job, calling all day long and asking for money it draws at your strings, and, it's tough. So I was afraid of the motivation factor, and we've found ways around that. So, when we heard from the regulators, because again, the Commercial Collection Agencies of America, we talk to the regulators all the time. There are several that know our names by heart, and we attend their meetings as well. So they get to learn the commercial and how it differs from the consumer. But, we had to make sure. And the one thing that we did do, Janet, was we increased some of our insurance limits just in case. And I've had some creditors that come back and had asked, well, if you're going to do this, how is it going to be protected? And all I can say is I think my E&O is fine, but maybe we'll up it. So that gets into some of those. As long as the state regulators allow us to continue to work from home, there will always be a hybrid, I think.
Meg and Tom, let's look towards tomorrow. Let's talk about, and we've got 2 slides here, and we're running up a little bit against time. So let's talk about, Tom, do you want to talk about what's on this slide, and then we'll jump to the next slide very quickly.
I think we touched on a lot of this already. We expect bankruptcy filings, the dissolution of businesses, or customers just simply walking away. The effect of inflation, process of invoice collection. I think we touched on all of those.
Sure.
And it's now just how do you prepare for the downturn that's happening. It might not be as bad as what we think, but it's going to affect a lot of us. With me, I just continue to use the resources and increase upon them. The first place would be with Yassine's, the FCFP or the CRF. If you guys are involved in credit groups, continue to participate and exchange information with your peers. Knowledge is power.
We talked earlier about reviewing your documents and attending credit group meetings. I know we talked about that yesterday. Remain diligent in your review and what you do on a daily basis. With the added, like Meg was saying, ask your certified agency if they've upped their insurance limits. Not a bad question. We're preparing for something that we have absolutely no way of knowing the impact of what it's going to bring to us and to our businesses.
And know that your third parties are there to help you, every single one of them. So if you're lost or you need more questions answered, I agree, Yassine has, 99.9% of all the answers in her credit group. But your agencies will also be there to help you, because we're all in this together. We all have this sick passion for the industry.
Yeah. That was scary if you said Yassine has 99% of the answers. That's pretty scary.
Yassine, I put our contact information on the screen. Your members are welcome to contact each of us, any of us, and we look forward to providing the resource materials with our presentation to you.
And we'll be sharing the PDF version of this with all of the registrants. It looks like we have one last question that came in right under the wire, and this one is anonymous, and it's for all of the panelists, and it just asks, are you seeing more claims?
It's interesting that you say that, because
Annette, what did our latest survey say?
On the 22nd is when our agencies I have a deadline to submit their account placement numbers. As part of the certification, our members have to report 4 times a year of what their account placement. So why that is a requirement is we pride ourselves on doing that analysis and those trend analyses and provide them. So that is, we should have that out hopefully by the end of January. So we will see. To answer you right now, and hearing the feedback from our agencies, it's yes, numbers are up. So we anticipate those fourth quarter numbers to be up, and it'll be very, very interesting. I know when we did the analyses back in the economic downturn in 2009, 2010, and I know we have to go, but one of the trends is that, you see an onslaught of business right away. And then the longer the economic downturn, the longer it is. And the numbers then start going down because credit isn't open, right? So again, I don't think we're gonna see anything normal, so it'll be super interesting. So we will make sure, Yassine, we always give that report to CRF. We'll be happy to share it with your members as well. So, but in the initial feedback is, yeah, numbers are up, way up.
Wow. I know from my conversations with my colleagues at CRF that you guys share a lot of data with them. I think that this is something that's going to be touched upon at their next forum, if I'm not mistaken.
It is. We're actually doing a panel discussion at the next CRF forum.
Ah, there you go. There you go. Okay.
I wasn't going to do that shameless plug, but part of that presentation is to digest the numbers from third and fourth quarter and what we expect for 1Q 2021.
I knew that you guys were talking, so that I'm glad that you shared that. I know that we're trying to be respectful of everybody's time, and in these days of going from one Zoom meeting to another, we appreciate everybody taking time out of their busy schedule to share in this really special education event. And thank you to our wonderful panelists for putting so much work into this and sharing your insights and your expertise. So fantastic. I don't have the little raise hand things on this Zoom version, so I can't do that for you guys, but we're incredibly grateful for your time and your expertise. And
it was our pleasure.
To all of the folks that are registered, don't forget to answer that quick little feedback survey, and we'll be sharing that with our panelists. So with that, have a wonderful day, you guys. And again, thanks for joining us. Take care.
Thank you.
Thank you.
Thanks, Yassine.
Be safe.